Well, Sean, since I mean, gee, had you heard about this from somebody? Or what's
Yeah, I've been meaning to go to. I just kept forgetting to get in.
okay? Well, this is now a four-part series, and this is part four. So we will run with it,
Okay.
and you ask any questions you want. So, have you lost money in the stock market, 401k, TSP, or IRAs?
My 401k is actually, I redirected my 401k about 4 months, 4 or 5 months ago, and it started making money again.
Yeah. Okay.
I was gonna say I would love to be able to move it out of the 401k and into something a little more profitable, though.
Well, that's one of the arguments we're going to make today. So that'll be good. How much of your investment portfolio is quote unquote guaranteed?
I don't have any portfolio at the moment.
Well, you got a
That's what.
401k.
Yep. How much is guaranteed? I have no idea.
If it's in a 401k, probably none of it. Yeah. Are you afraid of
Yeah.
running out of money in retirement?
Yeah.
Okay.
Imagine most
And
people are.
yeah, yes. That's. I mean, we're now living 20 years longer, so that's got something to do with it. Do you wish you could pay less in taxes?
Oh yeah,
That was
especially with the
last.
current government.
Yeah, there's a lot of places I wish I had a line item veto on my taxes. That's for sure.
Hmm.
Here's the problem as I see it. Americans spend about 75% of all the money they make on debt service and taxes. And this is how the average American does it. About 40% of our money goes to taxes of every $1,000, so $400. 23% we get to spend on whatever we want, our lifestyle. 34% or $340 of every thousand we earn goes to debt service. And then the average American only puts away about 3% into savings or investing. And again, it doesn't matter if you're a doctor making $25,000 a month or a school teacher making $5,000 a month. These ratios work out for almost all of them. And so what we're here to show you is there really is a way to eliminate debt, about 5 to 7 years, lower taxes,
Hmm.
and build tax-free wealth. I already began this, but my name again is Eric Martineau. My wife and I are both loan officers here at Nexa. There's my contact information. Just as way of background, I have a bachelor's in data management. I have a master's in telecommunications and an MBA. And when I got out of the Marine Corps, I got hired by these guys because all these telecommunications companies because I had put together the first voice, video, and data network. Now, what does all that mean to this conversation? Nothing, except that when I walked into my first Y Nexa meeting, I'd been in it about I don't know, 30 minutes, and this gentleman interrupts Mike and says, "Hey, Mike, do you remember me?" And Mike goes, "Yeah, you were here 2 weeks ago." And he goes, "Yeah." And Mike says, "You were the one that asked me to do this and this, and we did it." Now, I'm blown away because I've been a vice president of research and development at some of the largest telecom companies in the world. And here I am sitting
Yeah.
in this meeting listening to a guy tell the CEO, "Do you remember me from 2 weeks ago? I asked you to do something." And Mike saying, "Yeah, I've already done it." And then the guy has the audacity to say to Mike, "Well, you didn't do it the way I would have wanted to." And I thought, wow, you've got some big gonads there, dude. And Mike says, "Well, how would you have done it?" In a very inquisitive manner. And we've all seen this, those of us that have been in his Tuesday meetings over and over, where he takes advice from, some nobody in the crowd. And the guy
Yeah.
said, "Well, I would have done it like this." And immediately, Mike says, "Dan Fouts." Well, he just said Dan, but Dan, as soon as this meeting's over with, jump back into my thing. "That's a great idea. We're going to do that." So that's why I came to Nexa. You see, I wasn't looking for a job. I didn't have a mortgage license. It was my wife that had it, and she had been, trying to find something better. And so I had been snooping around on the internet to see if I could find a better mortgage broker than the one she was with. So
Mhm.
anyhow, 2 or 3 months later, again in another town hall, Mike says, "I hate the 401k," the very thing that you and I were just talking about, Sean. And he goes, "If
Mhm.
anybody's got a better idea, get a hold of me." So I sent him an email and said, "I've got a better idea for the 401k. It's called private equity banking, guaranteed returns, tax-free growth, no age restrictions, etc." This was an email I sent Mike. Well, because of that, Mike jumped on, and this is what Mike had to say. I'll just play this real quickly. Well, thank you for spending some time with me today. You guys can hear that, you had
right?
asked last December
Mhm.
if anybody had an idea that could improve on the 401k, that you and Matt were looking for an improvement on that. And so that weekend, I think it was Friday, I texted or emailed you and said, "Hey, I've got this idea." And I don't know how many emails we bantered back and forth with, probably, I don't know, 10, 11.
I have to appreciate your persistence. I tell you what.
What was it about private equity banking that clicked, that went off, that
Well,
changed your
honestly,
mind?
at first, the term private equity banking didn't click to me at all. I get thrown a million different ideas.
Right.
So at first, no disrespect, it was a loan officer throwing out this great idea, that I get thrown out at a million times. And we listen to them.
Yeah.
I don't always listen to them immediately. And
Right.
so once somebody really takes a minute though to go through it, and I go through all these ideas, and
Right.
my job is trying to pull holes in them and tell people like, this is why this idea won't work. And I went through it in the first few minutes of it. I'm like, okay, I realized the power niche, and I never heard of it before, and I'm kind of disappointed that I didn't hear about it after the fact, because it makes so much sense.
Right.
And so I was just, after going through it about 20, 30 minutes into the video, I was kind of like, hurry up and get to the end because I'm ready, right? Although you gotta kind of get all the details and the minutia of how the program works. But once I realized it and I took the time, it was not one of those, I realized this is not one of those things that somebody's just throwing out this cool little marketing idea.
Right.
This is a legitimate financial plan that anybody could take advantage of.
And I watched your YouTube video, Eric, at the 21-minute mark, and I'm like, all right, you know what? I got to look at this again. So I've been told about I've hated whole life insurance my whole life, by the way. So,
Yeah.
right. I'm more interested in accessing it to build other business models. So we were going to loan that company a lot of cash, but then Eric introduced me to this, and I says, well, maybe hold up. Instead of issuing a loan, maybe we put it all into these policies and then pull out interest-free or not interest-free, but low obligation loans that using your money twice, right? You have the insurance policy and loan the money. So I'm like, hold on, let's back up a minute. My hope is that we can get this done inside of 2020, but I know that's with underwriting, that's probably a stretch. So
No, it makes sense. Honestly, every single loan officer or any moderate to high income person has got to look at this program. And then even moderate to lower income, it still has significant benefit. But it's an absolute no-brainer. We need to do a demo with all the loan officers so they can see this private equity banking. Have a presentation ready and just show a loan officer first and foremost how private equity banking will help them in their business and their wealth management.
Right.
And of course, once the loan officer can see it, then they're really going to understand how their clients could see it help.
And I think that's where there's really so much power involved in this. I'm like, well, what's the normal human being going to do when they've paid off their mortgage and they've got $450,000 in a normal mortgage sitting there as a bank account that's theirs? They're going to either buy a bigger house or move someplace else. I mean, it's not like as if the game ends when people get out of debt. They use it to get out of debt, and then they use it to go and get back into debt with something bigger, better, and etc.
Well, I think using it for the fun stuff, right? Asset acquisition, even better than using it to get out of. I mean, get out of debt with it. That's great, but then you start getting into wealth.
Right.
Right.
True wealth.
Debt reduction is phenomenal. Get out of debt, and then use it to build wealth. And what a great way to build wealth, though.
Yep. Well, I'm glad you were willing to put up with me bugging you with so many emails that Friday and Saturday.
Because you were with Nexa, you made me listen. So
Well, I appreciate it.
I'm grateful that you did. So.
Thank you so much again, Mike.
All right, Brian. I'll
Have a
talk to you
great
soon.
afternoon.
You too.
We'll see you. All right. So again, that was what Mike said. So that's why I built this. But in my mind, here's the problem. We live in a system that expects people to be in debt. Well, that's putting 34% of us in debt and takes 40% of our taxes. And so I think the system's broken. Tony Robbins once said, contrary to popular wisdom, knowledge is not power, it's potential power. The execution of knowledge is where your power lies. And a lot of people quote him on that. But that's what we want to do, is provide you with the toolkit you need to do those two things: reduce the amount of debt and then reduce the amount of taxes and then build wealth. So part one I gave 4 weeks ago, and I talked about what private equity banking is. Part two, we talked about debt reduction. Part three, Marvin, who's on here with me today, we talked about how to reduce taxes by creating the proper organizational structures. And I've got Marvin on here again today. And today we're going to talk about how to move money from a forever taxed environment over to a never taxed environment. And so if you want to catch up on those others, I can send you the video for the other three, but
Yeah,
this will
please.
get you here. Yeah. Okay. I'll send those over once we're done. All right. So this is the first one. Oh, quick overview of it. The first one, again, shows how private equity banking can be used, one, to get out of debt, and two, to get out of taxes. Here's what you get with private equity banking. You get a cash accumulation contract from that the IRS has deemed is, I don't know, what's the right word for that, Marvin? I can't say. I mean, is it approved? Is it sanctioned? I used the word sanction last time, and somebody was like, "Well, sanction sounds like they're gonna, get on you." You're on mute, Marvin. You're talking, but we can't hear you. What word would you say is a cash accumulation contract?
Allowed by the IRS.
Allowed. Okay, I'll go in and change that to allowed. All right, thank you. So here's what you get with it. You get tax-free growth of all your funds and tax-free use of your funds for life. You have liquid cash. So you have anytime access, no age restrictions, no fees, no closing costs when you want to get money back. You get protection from creditors and lawsuits, bank failures. You get guaranteed returns. So things that you don't get, like I asked earlier about the 401k that's in the market where there is no guarantees that another pandemic is going to drop it by 37% in a couple weeks. Compound interest on all of your cash value and all the dividends that your account is making. And then this is one that I think is really powerful, and this is the dual use. So you end up with two accounts, one for saving money and one for when you get loans back. And the saving part never is reduced. It's kind of used as your collateral. And then you get the stability of working with some of the most financially sound organizations in the world that have been around for over 100 years and never lost money. That's what I went over in part one. In part two, I had a gal by the name of Danya, and Danya has a software that we use to help people eliminate debt. And so I kind of think of it, this way. America has more debt right now than we've ever had before, $17 trillion. And this is what we're able to do for folks. And this was the question that we answered in her class. If I could show you how to eliminate high interest payments and all your debt in 5 to 7 years without earning or spending any more, would you implement that kind of a system? And so that's what she brought in. We teach people how to do what Warren Buffett says: do not save what's left after spending, but instead spend what is left after saving. And so it's a tool. I call it a GPS. It's kind of like a GPS that does the math in the background, telling you where to move money and when, so that you actually can save more and get out of debt faster. Anyhow, that was what part two was. Part three was last week. Marvin and I were in here, and Marvin is a CPA, and he used to be with the IRS. And so we talked about business structures and, again, the different types of money. He went over the different kinds of money that have different rates of taxation, and then the kinds of organizations and how, again, they have different rate structures of taxation. And now today, I talked Marvin into coming back again, and we're going to talk about how to move our money from a forever taxed environment to a never taxed environment. So let's get that started now. Buckets of money. I look at the world as though, well, this guy that we're going to listen to here talks about two kinds of money. You've got forever taxed and never taxed. So I've broken it into three. Marvin, do you think that's accurate, what I've got in the three buckets? We got a taxable bucket, which is ordinary income, dividends, rental, interest, capital gains, etc. We've got tax-deferred buckets,
Tax-deferred.
qualified plans, and then never taxed. Now, last week you had me add on there tax-exempt because I didn't have that one on there. Have I now got them all? Death benefits, tax-exempt money, insurance loans, and defined benefits plans. Is there anything else that I need to add to that?
If you
Never
looked at
taxed.
the code and regs, you'd realize there's always something else we've missed. There's a lot there.
Okay, dear IRS, I'm writing you to cancel my subscription. Please remove my name from your mailing list. Robbins has a book called Money Master the Game, and in it he talked about a billionaire buying a $201 million life insurance policy. And then Tony Robbins asked the question, well, why would a billionaire buy so much life insurance? He said, won't his kids be fine if he dies early? And he said, believe it or not, the ultra wealthy do indeed buy astronomical amounts of life insurance. What they really want is a place to park their cash in an IRS sanctioned. That's where I got the word sanction from, was
There
him.
you go.
Okay, so we'll change. Yeah, well, that's the word he uses in his book, but approved
That's fine.
vehicle that allows them to grow their investments.
The IRS doesn't approve anything. They'll allow it or they'll sanction it.
They'll allow it. Okay,
Okay, you can use that method.
so here's what we want to do today, Sean. This gentleman gave a presentation that I bought years ago, and since I can't get Ed Slott to come in here, Marvin's going to answer the questions. So we'll use Ed to bring up some concepts, and then we'll have the freedom, you'll have the freedom, Sean, to ask Marvin. And yes, let me introduce who you are, though, Marvin. So Marvin has been in the tax world for, I don't know, over 25 years. Yeah, lots. And today we're going to talk about moving our money there. There's Marvin's contact information.
Consumer advocate, tax expert, and educator Ed Slott is here to help you rescue your retirement by following his time-tested method of avoiding the 5 silent retirement killers. The Wall Street Journal called best-selling author Ed Slott the best source of IRA advice, and USA Today said it would be tough to find anyone who knows more about IRAs than CPA Slott.
Thank you. Welcome,
Here's
welcome.
Ed Slott.
Thank you. Thank you. Thank you. Thank you. Hi, everyone. I'm Ed Slott, and this program is called Life Insurance for Life and Beyond. Well, first, why am I talking about life insurance? Because life insurance may be the most underused strategy to protect large retirement balances from being decimated at the highest levels of taxation. So before we begin, just so you know, I don't sell life insurance. So why should I care? I don't sell stocks, bonds, funds, insurance, or annuities. I'm a tax advisor, but it's all about the taxes. I also believe most people don't understand how life insurance works as an effective planning tool. I don't sell it, and I'm no expert in exactly how all the various life insurance contracts work. That's why there are life insurance professionals that you need to work with to fill in all the details. But I do know how life insurance can fix lots of money and retirement problems, and even create wealth. And tax-free wealth. And you know, I love tax-free. I want to give you enough here so that you'll understand what life insurance tax planning can do for you and your family, both during your lifetime and after your death. So why don't most people take advantage of life insurance? Because every time you hear life insurance, some people just tune out, or you put it off. And most times you hear about life insurance, you're hearing about it from someone who sells it. So maybe you feel like you're being sold rather than being advised. Maybe you think, they're just trying to sell me something. So you think, I'll avoid the meeting or avoid the discussion. And maybe you're right. Maybe you feel that you're just being sold, so you don't see a benefit to you. But I'm here to tell you, you could be wrong. I want you to understand what's in it for you from an unbiased, objective tax benefit point of view. So let me tell you why I believe life insurance is the missing piece in most people's retirement and estate plans. The tax exemption for life insurance is the single biggest benefit in the tax code.
All right. So let me ask you, Marvin, since you're here with us.
Okay.
What he just said about himself, do you sell life insurance or anything like it?
I gave up my licenses about 15 years ago, I believe, 10 years ago or
Okay.
so.
So you did have them, but not now. All right.
I'm
Consumer-
well aware of what life insurance is, but I give up my license.
There we go. Okay. So he made a pretty bold statement there. The tax exemption for life insurance is the single biggest benefit in the tax code. Do you agree with that? Oh, by the way, Sean, I introduced Marvin last time, but yeah, he went from GS2 to GS, what was it, 12 or 13, Marvin? 12.
Well,
when he got out.
9 years.
Okay.
And
And
as fast as you can move that far.
and when he got to that point, he said, you know what, I think I can help people save on taxes more than I can help by taking it. So he left, and he's been doing returns and such for the last, 15, 20 years?
It's close to 20 now.
Close to 20. Okay. So that's the voice that you can hear back behind there. And
Okay.
so, again,
There's a picture of me there.
yeah. Let's keep going with it. He says there's 2 major problems with retirement savings. One is affects us during our lifetime, and 2, that which affects us, our beneficiaries at death. In our
Exactly.
lifetime, he says, if you have taxable savings, a 401k, TSP, you have a problem. And that's what you just got through explaining, correct?
You're going to pay tax on that when you pull it out.
Okay.
And then, like he said, the beneficiaries are going to have the same problem you have. They're going to have to add that to their income and pay the tax or whatever bracket they're in.
Got it.
So if your beneficiary is pulling $100,000 a year and he decides to pull money out of that retirement account, He just put himself in a higher tax bracket.
Got it. Okay, so here he says that retirement killers are risk, and he points out what kind of risk it is. One is the stock market volatility risk, which I guess anybody that's had any money in the stock market understands how that goes up and down. Bigger risk, though, he says, is tax risk. And I guess that's what you just got through explaining to us.
That's what I just got through explaining.
Right. So the bigger risk is tax risk, and that's what you just got through saying. Okay. So retirement funds are not real money. Real money is what you keep after taxes.
Correct.
I like that. Okay, so the tax risk. So if we've got an IRA, which would include a SEP IRA, a 401k, a 403b, right? All that is tax deferred and not tax free. Okay? So that leads to the question, how much am I going to be taxed when I finally get to that point and I'm in retirement? Now, if you listen to most financial advisors, one of the things they say is, oh, but when you get to retirement, you're going to be earning less money, so you're going to be in a lower tax bracket, so you'll pay less. But you just explained that a couple that's retired, getting their max Social Security, and they want to pull 100 grand, they're now making 170,000. That might be more than they made when they were working, right? Or is that what you were saying?
Yep. That's pretty much what I was saying.
Okay.
I've done taxes for some people for many years, and I've watched their income grow. And then as they pull the money out of their retirement, they have 20% withholding generally out of their pensions, out of their Social Security, and they still wind up paying another 20% on top of that. And that's just the federal side.
A couple years back, I did a presentation where I talked about current U.S. debt, and Sean, you made a comment earlier about,
Yeah.
especially under our current government. Well, in 2022, we had 31 trillion in national debt, and we had 172,000 in unfunded liabilities. I pulled this just the other day because Marvin and I were going to give this presentation, and now that's up to 34 trillion in national debt and 214 trillion in unpaid debts. That's Social Security, correct, Marvin? When it says unpaid?
Well, that's one of them.
One of them, okay. Now,
They figure the commitments the government has as many times what the national debt is. And
right.
Social Security is one of them.
Got it. So this is our tax history, and right now a couple making 450,000 currently pays 23.69% in their marginal tax rate. But all that goes away. When is it? 2025?
26.
I shouldn't say it goes away, but there weren't enough votes when Trump was running things to get it passed into law forever, so it sunsets or something like that. Is that?
Yeah, most of his tax benefits he put into the system sunsets by 2026.
And I guess then the question becomes, do we think taxes will go up or down regardless of who gets put in power again?
Let me answer it this way. When I was, my father passed away, I went through a lot of his stuff.
Right.
I pulled out some of his check stubs. 1970. He raised us really well. We were in middle class.
Okay.
It surprised me when I saw his check stubs. Basically, he made $200 a week in 1970. And he had his cars paid for, his house paid for. We had nice vacations. We lived well.
On
He made
200
$200
every week? Okay.
Every week he made that's $10,000 a year.
What did homes
10 years
cost back then
later-
where you were at?
Hmm?
What did homes cost?
How much was a house?
Yeah, how much was a
He
house
paid
worth where you grew?
$27,000
Okay.
for his house back then.
All right.
I sold it for 400,000, something like that. 50 years, 50 years later.
Yeah.
10 years later, I was making 50,000. And that put me in the top wage earners, I guess, in the country.
Uh-huh.
Today, 50,000 will put you a family of four in poverty.
Right.
It's called inflation.
Right.
And taxes are a graduated scale. So as inflation goes up, the taxes on that over that $50,000 goes up. So now you have to make 100,000 to do as well as you did on 50,000 a couple of years ago. And the tax rate on 100,000 is more like 20%.
Okay.
And then you pay a 5% Utah tax. Other states are higher or lower. So a
Right.
quarter of your money is going away for income tax.
Well, I'm in
You're still
Texas, and I've got
struggling
high
to
taxes
live
here.
on, yeah,
Sorry, I didn't mean to interrupt
especially if
you
you run a business.
there. Right.
They
Well,
have
you
a
got
privilege
buildings.
tax there.
Yeah. Well, and those of us that are loan officers understand what houses cost. All right. Well, here's where Ed Slott talks about these risks.
So you need to create a plan to move your money from accounts that are forever taxed to accounts that are never taxed. Life insurance is the best provision in the tax code to do that. Wouldn't you sleep better at night if you knew your retirement savings were no longer subject to these risks?
So before I heard that, I had never thought about the fact that we could move money into a place that then becomes tax-free. So let me ask you that question then, Marvin. How does life insurance remove both market risk and tax risk?
Well, life insurance is kind of a fixed contract that you receive interest on
Okay.
the cash portion. And the IRS recognizes it as a necessity that should be non-taxable.
Oh, is that
So-
why they call it non-taxable? Because they say that life insurance is a necessity for the family?
Mhm.
Oh, I didn't know
And
that.
it's supposed to, the theory in taxes is if it replaces something valuable, it's not income, it's a replacement. So if your house burns down and you get a brand new house from life insurance, they
Right.
figure that's a replacement of the house. If you
Okay.
die, the life insurance is a replacement of your earnings. So
Yeah, but my earnings are going to be
So
taxed. So why do they
reimbursed.
allow this to be not taxed? Sorry for talking over you.
they just want some money.
So okay, but
But as
no,
far
but
as life insurance goes, it's a reimbursement for the loss.
that's okay. I didn't know that. So, Sean, by the way, any questions so far? Again, he and I can probably chat this up, but
Not yet. I think any questions I have are going to be answered soon.
okay.
I love these questions I get from clients about life insurance, about inheritance,
Mm-hmm.
about I had a loss and the insurance company gave me a check. How much of that's taxable? Well, how much of it's a reimbursement? The reimbursement portion is non-taxable. If they gave you something that wasn't reimbursement, it could be taxable.
Well, and you know,
So if you have $1 million life insurance policy on somebody and they pass away, that's a reimbursement for what they were producing. You look at the banks, most of their employees have a life insurance policy on them, owned by the bank.
okay.
And they lose that employee, they've got that reimbursement.
So another thing that gentleman said, Ed Slott said, was that he said a lot of people don't use life insurance as part of a plan. So you know, cash
1%
value
do.
insurance can and he also points out, you know, that we're talking about whole life insurance, not term or an IUL. But he said another issue that people have at death is liquidity, because they're going to have to pay taxes on it. And you mentioned something a minute ago that I had not truly understood, and that's that if somebody leaves a 401k to their family inherits the taxes that are due on that money also.
Yep.
Which again, it's
Yes, sir.
interesting because because again, that was somebody's money. Why would the government make that one taxable yet an insurance policy not? So again, I'm not understanding why they do it, but okay, that's what they do. All right. So he says the number one strategy is to turn taxable money into tax-free money using the tax exemption in the life insurance by moving your money from a forever taxed bucket to a never taxed bucket, which I guess then would indicate there are two kinds of money. There's money that's forever taxed and there's money that's never taxed. Do you agree with that?
Yes.
Okay.
So now you know you have tax exposure, stock market risk, and a liquidity problem. So how can life insurance help? Two ways. During your lifetime, so there's something in it for you right now, and after your death. During your lifetime, you have the ability to reduce both stock market risk and tax risk by moving your money from accounts that are forever taxed to accounts that are never taxed. You can actually do that two ways, Roth IRAs and life insurance. Both cost money now, but with life insurance, you'll be creating a bigger pot of tax-free money later when it's most needed. It would be great if you could do both and turn your entire estate into a tax-free windfall, both during your life and after death, but the more powerful way is with life insurance. And again, I'm talking about permanent life insurance that has cash value. You can contribute more with life insurance than you can generally to a Roth.
Okay, so can you talk to both of those and how we can move our money from the taxable world to a non-taxable world?
Well, there's a few ways of doing it. The problem with qualified plans, even Roth IRA is a qualified plan, so there's limits as to how much you can put into it.
Oh, okay.
The beauty of life insurance is you can build your bucket so in theory, there can be no limit. I've known people that have $10 million policies and they can fill those.
Right.
I'd
Yeah.
like to be there someday.
I just spoke to a doctor yesterday who she came up on her 1-year anniversary of her policy, and she's able to put in close to $300,000 a year. And we talked. Now that wasn't. And please don't anybody listening to this think that that was what her obligation was. Her obligation was down about $25,000. But what she could put in was up to $300,000, and it then all became tax free. And so we discussed, how much of her total salary on a monthly basis could be shoved in there to just grow it and grow it and grow it. I'm going off on another tangent, but yeah, you're right. She's able to put in a huge percentage of her total salary. So forget about it being $300,000, whether it was $30,000 or $300,000. She gets to put in almost, all of her income through something like this because I structured it properly.
So now you know you have tax exposure, stock market risk, and a liquidity problem.
Oh, we already saw that. Sorry. Okay, so here we go. Income, dividends, investment gains, those are taxable. Qualified plans, those are tax deferred. And then we finally get over here to the never taxed. Okay, so, and I already asked you the question, how can we convert money then that's taxable to a non-taxable environment? We already talked about that too, so sorry. Okay, so the plan.
Well, there's a number of ways of doing it. Just when you get the tax-free money, you put it into your life insurance.
Or when you get, well, see, now here's what I've always told people. You tell me if my plan that I tell people is accurate, or if you agree with it as a CPA. So lower your taxes as much as possible with business structures. You're
Right.
shaking your head, yes, okay. Pay taxes now. Now, why would I argue to pay taxes now? Does that make sense? You're a CPA. Does it make sense to pay taxes now or defer them in a
Let me
tax?
change one word on that.
Okay.
I'd say address taxes now.
Address taxes now. Diane, will you take a note for me on that, please? Thank you. Okay, my wife is watching, so she's great at taking notes while I walk through this. But okay, so address taxes now. Okay, so if it makes sense to defer it, you do it. Okay.
Time.
And then move money into the never taxed pocket. That's my simple way of saying
Correct.
it. Okay. And then use insurance loans to access funds that are tax-free for life. That is the plan that I have told people to do for years. How would you modify that? How would you agree, disagree?
I just made one modification. That was addressing the taxes rather than paying them.
Right. So address them. And so when you say address it, what do you mean by that? Because again, that's
there are several ways you can get tax-free money available to put into that life insurance property policy and be able to address the taxes. Say you sell your main home and you have a $500,000 equity,
Uh-huh.
and you take that money tax-free,
Okay.
and you can put that money into a life insurance policy. Or you can pay your kids out of your business, minor children, up to $13,850 tax-free, and you can have them take that money and put it into life insurance.
Okay. Now I'm understanding. And by the way, and I wasn't understanding it when you first said it, but now that you mentioned it, that's exactly what Diane and I did. So we lived in Utah, and our daughter got stationed in Texas, and we decided to move. So we sold a home. And since it was our primary residence, as we all know, we were able to take a chunk of money because it went up in value. And then we came here and we wanted to buy another house. That was the, first item of business was to buy a house. But before we bought the home, we took the money that we got from the first house, we shoved it through my policy, and then borrowed back against it to use as the down payment with UWM. So, yeah, we did exactly what you just said. Okay, thank you. Okay,
You address the taxes and have the money to put in.
That's correct. Yeah. So Tony Robbins says you pay your taxes when you earn them, so it would have been better if he had said you address your taxes when you earn them. But once you deposit it, your after-tax dollars within a specific type of life insurance policy, the IRS says you aren't required to pay taxes as it grows. So never taxed. And if structured correctly, you aren't required to pay taxes when you pull them out. So in your mind, you're also adding in here not just stuff I've paid taxes on, but stuff that are monies that could come in that are non-taxable or tax exempt.
Yeah, I buy assets. I suggest people buy assets with their taxable money and use depreciation to reduce that tax. There's other strategies.
So like a car or whatever, then you put it into an LLC and you write it off. Okay.
You
So
buy a
while-
tractor for your farm, write it off, and take your depreciation, take it out of your policy, write off your tractor,
So
reduce
give a
your
loan to
taxes,
yourself. Okay.
get more money to put back into your bucket.
And that's the thing with a property high. See, now Sean, you haven't seen the first three parts, but a property structured high cash value insurance policy is going to have cash value monies that you can use to borrow and purchase assets, like Marvin just said, from the very beginning. You don't have to wait like on a traditional whole life policy 5 to 7 years until those restrictions are off. So if you've got the right kind of insurance company, and you can't do it with all of them, but if you do it with the right kind of policy and the right companies, then you do have access to those funds to use in your as a family bank, if you will.
Okay.
And so my question obviously is, if this is my forever tax pocket and this is my never taxed, who owns both pockets? I do, right? I mean, I have access to the money that's sitting here, and and I pay taxes on that. So okay.
So don't just sit there and admire your IRA like most people do. Leverage it now. Use it, leverage it, or lose it to possible future higher taxes. Never underestimate the value of leveraging IRA money by using it to pay life insurance premiums.
Okay. Now, I'll be honest with you, Marvin. The first time I heard that, I thought, okay, that makes sense. And I did it myself. But in the 6 or 7 years that I've been doing this with clients, I've never had the guts.
Oh, you froze up.
I said, I've never had the guts to tell somebody that they should do this. Are you frozen too? No, Sean, you're still there. So like Sean just asked, Sean said, well, I have a 401k and I wish I could do something with it. Even if I had a client that had said something like that to me, I would never have suggested to them that they pull monies out of a 401k to buy insurance. Can you talk to why you think that's okay? So should I cash out my 401k early? Which is, like I said, I did it myself, but I never as an insurance agent, have ever suggested to a single client that they do it. So I've got a CPA on here. What would you say and why?
They're going to get hit with a tax bill
Right?
to begin with. But once they get it into that policy and it's sitting there right, they should never have to worry about that tax bill again.
That's correct.
And it's going to grow. So I'm going to go rogue for just a moment.
Please.
I've done tax returns for people in high school through their working years and through retirement.
Wow.
And there is a landmine that Congress has stuck into the tax code that's going to blow up and hurt you if you go through their traditional qualified 401ks, IRAs, etc.
Mm-hmm.
And that's called Social Security.
Okay.
For the normal person, when they collect Social Security, in theory, it's non-taxable unless you have about $20,000 of other income. So you pull $20,000 out of your 401k, 85% of your Social Security becomes taxable along with that 20,000. So
Isn't that
in
what
many
you were
cases,
commenting on the other
people-
day to me? That you said some elderly woman that you knew was taking Social Security, and because she merged that with her 401k, all of a sudden she was in this like super high tax bracket. Is that
She
what you're
pulled a
alluding
few
to?
dollars out of her 401k,
Uh-huh.
and she thought, well, it should only cost me a couple $1,000s. They withheld $2,000 or $3,000, but she had like 30,000 or so in Social Security. She pulled 20 or 30 out of her 401k. Now all of a sudden she has $60,000 of taxable income she's paying tax on.
Got it.
So you pay $6,000 or $8,000. There's almost a third of her 401k withdrawal going to taxes. That's the federal side. Then the state wanted their 5 or 10%, depending on what state she's in.
Right.
So now she's looking at over $10,000 going for taxes because she took 30,000 out of her 401k.
And
It's very typical that when I work with retired people, a lot of them have a pretty substantial Social Security. You have a couple of maximum Social Security. They want to pull 100,000 out of their retirement account. So now they're paying tax on 150,000 to $170,000 of taxable income because they pulled 100,000 out of their account. So now they're in a higher tax bracket. They're paying 25% tax on $170,000.
right.
So they're up around 40%. Then you add the state tax, they're over 40% tax. Now, if you use life insurance, like he's saying, this is exactly what he's saying. You take the life insurance and you pull the money out of the life insurance, but you borrow that money. A loan's not taxable. You've got your $100,000. Got your cake and keep it and eat it too.
Right.
Because you have 100,000 in life insurance, and have 100,000 cash you can use, and it doesn't affect that Social Security. So if that's all you have is Social Security, you're not paying any tax.
Right. Now, I did have one client about 3 years ago who asked me that question, and he said, well, I want to be able to start pulling out, don't quote me on the number, but I think it was $1,000 a month. So like $12,000 a year is what he wanted to pull out. And I said, you need to go talk to your CPA to make sure, one, that you can cover the penalties, and two, that it's not going to put you into a higher tax bracket. That's the only time I've ever said for somebody to do something like that.
Well, if you cash out a 401k, it can't help but raise your tax bracket.
Right. And that's what that, so I'm still safe as a life insurance agent as telling people to talk to your CPA.
Yeah.
To make sure it's not, as you just said, address the taxes, right? Because if pulling that out, it's going to put them into a higher tax bracket. It might not make sense. So what he said might not make sense in some instances with some individuals.
But while you have minor children at your home, you can handle the extra income a lot better on your taxes than you can later when you don't have
Yeah.
minor children
Okay.
because of the child tax credit and other credits.
So again,
So every
coming,
situation is different.
Right.
Everybody's tax return is different. That's why they say talk to your tax advisor.
well, and just like a loan officer, I'm not allowed to do the job of a real estate agent. As an insurance agent, I'm not allowed to do the job of a CPA. So that's why I'm so glad you're on here talking about it because, yeah. All right. So how can life insurance be used to create wealth? Now, I'll talk to this one, but this is the part that I think is so important. I call it optimizing every dollar. And here's one of the cool things about insurance is that once you put it into a properly structured policy, that money can never shrink. I repeat, never shrink. In fact, it has to grow every single year, and it's a guaranteed growth rate. So that's why I say optimize every dollar. That's why I was saying just a minute ago that I was talking about that doctor. And although she has a minimum that she needs to put in, which is like $25,000, she could put up to almost $300,000 a year. And so we were strategizing on how to get that through the policy, even though she leverages some of that come back. You know, it's not like as if she's going to kill her lifestyle and all of a sudden put everything into savings and never have a penny to live on, right? But she's going to put it in and pull it out. And that's what we were talking about, was the amount of money that she could do it. So here's what I mean by optimize every dollar. One, once you put money into this, and I call it private equity banking because it's really what you're doing is changing your banking function from a typical bank that doesn't pay you anything on your money, or very little, to a bank that pays you anywhere between 4 and 6% for the rest of your life. So you've got lifetime growth, no market loss, no tax risk, no fees, compounded interest on all the growth and in the interest, and then it's guaranteed your entire life. And that's what I mean by optimizing lifetime growth of every dollar. And if you start, whenever you start that, whether you were 50 years old like me when I found out about this concept, or you're 20, the sooner you start and the sooner you begin that compound interest, the bigger it can grow, obviously. This is another quote that I really like by Robert Kiyosaki. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you get to keep it. That, I believe, those last two statements, how hard it works for you and how many generations you keep it, by putting it into a life insurance environment. And Marvin, we talked about this last week. If it's in a trust, if the trust is the beneficiary of the life insurance, that trust can then dictate what happens with those monies, and they could dictate that you continue this wealth transfer to younger generations for forever and ever, and have more policies purchased with some of that, as you just put it, tax-free money, and continue this banking legacy for a family forever. Is that
A properly designed trust can give you a bank for generations.
right?
And I think that should be a goal for every family.
To create a generational wealth machine or
Yes, to have
bank
that
account.
trust that creates the wealth. And if when you're making your money, you might be too old to get decent insurance, but your children, grandchildren can be the policy, the ones that be the insured, and that can be put into the trust and be able to build.
Exactly. Yeah. Okay. So, and I was just talking about this a minute ago, but he says he talks about some of the biggest mistakes that people make about life insurance. Think of life insurance as a cost and not an asset. And then another one, trying to pay the lowest amount possible for life insurance. When I build a typical policy, the first $100 of it, $35 of that is typically going to go toward insurance, and $65 is going to go towards savings. So here's you're getting that structure, Sean, that I was talking about a minute ago. And so, I call it your insurance tax. That's my term, not an official industry term. But so 35% of what you're putting in there is actually buying you insurance. But if it's properly structured, you'll have the opportunity to put in what's called PUA, paid up additions, which is just insurance speak for savings. So you should be able to, for every 100 in target premium, put in another 100 in PUA. So if you do that, now your insurance tax, as I call it, is down to 17.5%, and your savings portion is 82.5%. And again, if it's properly structured, you'll even be able to do more than that, where you'll be able to put in another 100 in PUA or savings. And so now you're looking at a percentage of about 11% of your money is actually going toward insurance, and the rest of it's going into savings. That's again what makes this whole thing powerful, because the IRS allows the whole thing to be tax exempt. Let me keep going then. So again, another one of, he says, the most common life insurance mistakes is hold life insurance in your own name instead of an LLC, a C Corp, or a trust. Can you speak to that, Marvin? Well, you just kind of did.
I just kind of did.
Yeah.
Yeah,
Okay.
the trust, you can design a trust to fit whatever your needs are. It's just it's a contract. And you have a trustee that carries out the wishes of the contract, of the grantor. So you can design that in the insurance policy inside the trust however you want or desire.
Okay. And Sean,
as the
again,
grantor.
I go over this in the first presentation, but there are three parts of an insurance policy. There is the body that's being insured, there's the owner of the policy, and then there's the beneficiary. So in most cases, all cases, a human being is the body, but the owner of the policy that pays the premiums and has access to the cash value could be an LLC, it could be a C Corp, it could be a trust. And then the beneficiary, the person or the entity that's going to get the death benefit and the proceeds, again, could be an LLC, a C Corp, or a trust. And in last week's presentation, Marvin kind of talked about why it might at one point be a good idea to have it in an LLC and then later put it into the trust. Or was it the assets you were saying should start in one and then move to the other? Yeah, I think it was assets.
Yeah, depreciable assets should be in the LLC.
Yeah. And then once they're
fully
depreciated, yeah.
then you put them in the trust.
Okay.
The cool thing about you depreciate out a building, you put it in the trust. When it comes out, it gets a step up in value, and you can start depreciating again.
So Sharon, you just asked the question, does it have to be or should it be? You mean, does the insurance have to be in an LLC or should it be in an LLC? Is that what your question is?
Yeah, because the beneficiary should just go straight to the kids, right? I don't have to protect it like I would my house and everything, cars, other houses.
Right.
Because if my beneficiary kids on this policy, does it matter? Why would it matter?
Well, one reason it might matter, and you tell me if, well, no, you don't have to tell us in an open forum like this if it makes that sense, but let's say that after you pass, you still want to be the little dictator of how your money is spent, not just giving it away. And so, well, you're busy holding a grandbaby, right? So,
Yeah.
Okay, there we go, cute little kid. So let's say, Sharon, that you wanted part of your money not only to go to your child that just had that child, but you want part of that money to pay for that grandbaby's education. If you just give your child that money, if you die tomorrow and she gets your death benefit, your daughter does, then your daughter can spend that money any way she darn well pleases. But if you've got that money in a trust and it says, oh, by the way, child of mine, my granddaughter gets a percentage of that so that she can go to college too, now the trust is controlling that money and making those decisions that you wanted made for your grandchildren, instead of as soon as the money goes into the hands of your child, she can change your mind, if that makes sense.
It does. So then the same trustee, if we put it in the same trust we do our other things, that trustee is then in charge of however I'd say to spend it. Because couldn't we say, like, I have 3 grandkids and I go, okay, 2 daughters, 3 grandkids, and in the beneficiary, I already set it up that way. And as I have more grandkids, I stick another one on. Would that work, just to be done with it and not have to mess with the trust?
Exactly. Well, no, you'd still mess with the trust. Again, Marvin, you jump in and correct me on this because you're the expert at it. But what you wouldn't have to mess with the insurance, Sharon. You would say the Sharon Stewart Trust, and I'm just making that up because I see your name on the thing, right? But the Sharon Stewart Trust is the beneficiary of my life insurance. Then inside of that trust, your trust is holding your will, and then inside of your will, you can say, well, my first daughter is really cool. She gets everything, and my second daughter sucks, so she doesn't get anything, or whatever you want. I'm just making that up. Or I don't want either of my kids to get anything. I just want it to go to the grandkids. You can modify that at any time you want, but the insurance company doesn't care about that. All they care about is you passed away, your money goes to the trust, it's tax-free.
Something you could help me figure out and decide if I have this policy and how to, as I have not set up a trust yet for my house, anything.
Okay.
That's a Marvin
that
issue,
a-
not
I
Eric.
specialize in tax advice. I'm a tax consultant, but I work with some people that are very good at setting up structures.
Okay.
And they do trusts. They do revocable or irrevocable. Now,
I had to learn all
and
that.
there's some cool things you can do with a irrevocable trust that they can help you get set up with. And then I do taxes for them, and I help the client find out what cool things an irrevocable trust can do for them after they're set up.
So Sharon, did that answer your question? I saw you put yourself on mute because probably the grandbaby of it.
Yeah, she's in this ring now. Yeah, I need to talk with all you further, make sure I have these things structured correctly. It
Okay.
does so much, and I know I'm taking advantage of everything right now.
Okay.
You can also
Sean,
use a trust
Diane,
for a
either of
bank.
you have any questions about this before we move on?
Not so far.
Okay. Diane? No? Okay. All right. He said another common mistake is not knowing it's tax-free. And I'll admit that even when my father passed away and left my sister and I and my brother some inheritance money in a insurance policy, and I'd been an insurance agent for about 2 or 3 years at that point, I still called up to double check that it was going to be tax-free because it was just like, this is too good to be true. I can't be getting this much money and not owe anything to Uncle Sam.
Next question I get, Ed, why doesn't everyone do this? You know what? I don't know. I also think that insurance is not sold properly, so you look at it as a cost rather than investment. Many people think they're buying something and they don't see how it fits into a plan like I've been telling you about. A good financial advisor or insurance professional can explain the planning aspects.
So that's why I've brought in the Marvins of our world to help us understand the larger plan. So can I ask you that then, Marvin? How do you see, for the discussion that we've got here, life insurance fitting into the larger plan of somebody's portfolio and retirement planning and, just overall structure of their family life? How do you see that as part of it in a larger plan?
The more I have these discussions with you, Eric, the more I see how life insurance isn't just part of the plan, it is the plan. You take your money and all through government, all through crime, they have laundering.
Right.
But life insurance is a legal, proper way of putting your money in a place where it's tax-free.
Right.
And you can have it grow and protect your generations without Uncle Sam coming in and say, well, we've been keeping track of your money. We need it now. We're taking it. Life insurance isn't even recorded with Uncle Sam. They don't know how much you have.
Oh, really? And you made the same
I don't-
comment to me a couple weeks ago, I believe, in our other presentation about trusts. So both life insurance and trusts are places that the IRS doesn't lift the sheet up and look underneath it, if you will.
Yeah.
Got it.
They're anonymous.
Well, and now that I think about it,
You don't record the trust with the county.
right?
You don't report your life insurance policies to the IRS.
Right.
You do your 401k.
Well, the IRS, I mean, the insurance companies still have certain guidelines that they have to follow, and I'm sure they get audited by the IRS to make sure that my policies that I write for clients don't become taxable, which is called a MEC or a modified endowment contract. But I think
Correct.
anytime, so like I had somebody, again, this is for a different presentation, but it usually, you have to, the guidelines the IRS has made about these policies, you have to keep them for 7 years. So this isn't a get rich quick scheme. This is a new lifestyle and wrapping it in, as he's just said here, part of a larger plan. And if it's part of your larger plan, you're not getting rid of it a week and a half later once you've quote unquote made the money tax free. The IRS comes back and says, nah, they keep an eye on it for 7 years. But I think the way the IRS is keeping track of it, if I'm understanding you correctly, Marvin, is that they're talking to the insurance company and saying everything compliant within what you've got. Show us a handful of policies, and as long as they fit the guidelines, then we're not going to go talk to Sean or Diane or Eric about their specific policy. Is that probably what's happening?
if you have money coming in through a credit card,
Mm-hmm.
collecting money for payments,
Yep.
that's reported to the IRS. If you get a payment from an individual for non-employee compensation, that's reported.
Right.
If you put money into a 401k, a Roth, or a traditional IRA,
Right.
that's reported to the IRS. But what's not reported is your investment in a life insurance policy.
Got it.
The company may have hoops to jump through to keep it from necking. So they tell you, okay, you can't do this, or else it'll become taxable.
Well, because
But
these things are
They're
known
not going to report
entities.
the money you put into that policy.
Right, but see, my software, which you've never seen, Marvin, because I've never shown you the backside of what I do. But when I'm building a policy for somebody, Marvin, I hit View Illustration, which is the button that creates the illustration for somebody,
Mm-hmm.
and in the background,
I've done some of that.
okay, the algorithm is looking to see if this is breaking any of those IRS regulations, and if it does, then I get a flag that says this policy is now a MEC. Do you want to move forward? Because there are people that they're okay with that, and I'm not going to go into why and when that would be proper, but it's very seldom. But so at that point, I just hit nope, and I go back and I modify what I know I did to make it there, because what I'm trying to do, because what I promise my clients, Marvin, is that I'm going to get them a bank account as close to the limits of what the IRS has set that allows them to have the biggest bank possible.
Exactly.
And the smallest insurance policy possible. And so I'm always touching that limit. So I'm on, and again, my clients don't see it, but
Right.
I go to that limit on almost every single policy. I get to the point where my software says, okay, you're a MEC now, it's taxable. I ratchet it back a little bit, and then I show it to my client and say, okay, this is the best bank account that you can get. And that's how I craft a policy, but that's after talking to an individual.
So that's why you're staying below the line.
So the next one, he says, another common mistake, thinking a qualified plan is better than permanent cash value life insurance. And we've talked about this in a lot of times already today. But again, it was so mind-blowing to me that I heard a CPI saying it. I want to throw on this last little bit.
Ed, which is better, saving in an IRA or an insurance policy? That's interesting. Life insurance wins hands down. Let's compare. Let's compare life insurance to a tax-deferred retirement plan like an IRA or a 401k. If you compare life insurance to tax-deferred plans, life insurance has several advantages. First, with life insurance, you have lifetime access to cash value, tax-free and penalty-free. With an IRA, withdrawals can be heavily taxed, and penalties too. Also with an IRA, after you're 70 and a half, you're forced to withdraw and pay taxes whether you like it or not. Life insurance provides a tax-free death benefit, income tax-free, estate tax-free too if owned properly. And with life insurance, there's no risk of future tax rates increasing. I mean, they could increase, you just don't care. Just so you know, the Roth IRA also provides this benefit. The reason you don't care is because what would you care about taxes if it's all tax-free? But here's what you don't get with life insurance that you do get with an IRA and a 401k. With life insurance, you don't get a tax deduction like you get with an IRA or 401k. But a tax deduction these days is a trap because you'll pay much more in taxes later.
All right, so I think we hammered that one home. Any other comments on that one, Marvin?
Absolutely right.
That's right. Okay. Sean, Sharon,
There's
Diane.
no need.
I look at it this way. Reducing taxes and eliminating debt is the part of the iceberg that we can see. And unfortunately, that's where a lot of people stay. But building wealth, once you've overcome those hurdles, once you've put these things in place, is so much faster. Just what Mike said in the beginning of that very first video. You know, getting out of debt is nice. But after you're out of debt, using this to build wealth and to acquire assets that build wealth for you, that's where this becomes so powerful. So let's turn this into something that is not just transactional, but instead something transformational for all of us. Let me open it up again. Sean, we've gone about an hour now. Any questions at this point?
How do you I guess it's the whole actions. How do you start it? How do you put money in? How do you withdraw money?
Okay. So the first
Is
step.
that
Yeah, that's a great question. So how do you start this thing? So the first step is to sit down with somebody like me that does insurance and walk through. I ask financial questions. As you can tell, for me, this is part of a bigger plan. This isn't just, we've all talked to a life insurance agent that's done the, well, what happens if Papa San doesn't come home tonight? What's going to happen to Mama San and the kidlets? I don't have those conversations with people. I ask you about where you want to go financially. And then based on those things, I try to build an illustration that can get you to those goals that you've told me that you have. Then once that's done, and you like that illustration, it isn't chiseled in stone yet, but it's a place to start, which then allows me to go out and start an application with the insurance company. We put that in, which basically allows them to start the medical process to make sure that, medically they're willing to insure you. If that isn't possible, then plan B becomes find somebody in your family that is insurable. And if that plan B doesn't work, then it's time to find somebody that's a business partner that is insurable. So the idea is to find somebody that is insurable, find that body, because what we really want is a bank account, and it doesn't matter to me if that bank account is created through you being the body, your spouse being the body, your children being the body, adult children, that is, minor children can't do this. They can get insurance, but they can't get this kind of insurance, or a business partner. Then we build that structure. You go get the medical stuff taken care of. That usually is a month or two. Once that's done, the underwriters, just like an underwriter in your world or our world of loans, comes back and says, okay, it's approved, but with these conditions. So then I get back with the person that I've talked to and I said, okay, the underwriter has approved this policy with these conditions. Do you still want to move forward? We modify the illustration to fit what those conditions are. And I guess what I'm alluding to there, just to be clear with you, is that I want to build you the biggest bank account that I can build for you, as I said, with the least amount of insurance. And so the underwriter might come back and say, well, I'm not willing to give this guy that much insurance, so I have to ratchet it down just a little bit more, right? And then we move forward. That whole process takes 2 or 3 months. And then once all that's been approved, then you can begin the process. Now you asked the question also, do you have to have money up front or not? It depends on your finances. If, like you said, you've got a 401k. So if you told me, hey, Eric, I've got X amount in my 401k, even though we just went through this whole presentation, I would still say, go have a conversation with Marvin and figure out what portion of your our 401k is worth pulling out now, or in what lumps. And then he and you would get back with me on what that conversation was. And that would be part of the strategy to build you a proper illustration, because you've talked to Marvin about it. You guys then give me the instructions on how you want that crafted. Then I go craft the right policy for you. But anyhow, once all that's started, and once we've got that in stone, in other words, once the underwriter gives it their approval, there's not much going back after that. You can't modify the policy. If you run into a ton of money someplace in the future and your policy only allows $10 in the policy, then that's all you can do. You just have to get another policy to move forward further than that. But that's usually what we try to do. Does that answer that question for you, Sean, as to how the process works?
Enough for now.
Okay.
I had a couple thoughts as you were saying that, Eric. It doesn't matter who the body is that you're insuring, as long as it's related to you or a business partner. The owner controls the money, correct?
Yes. So there's
So even if he insures his wife or his kid or whatever, if he owns the policy, he controls what happens with that money. I just wanted to clarify that, correct?
That is accurate. And that owner, as we said earlier, could be an LLC or a trust also. And then the trustees are the people that make those decisions. Mm-hmm.
And then the beneficiary could be the trust. Then
the owner and
once
the
the
trust.
policy, right, and you use the term illustration, and illustration is basically just it's a picture, if you will. That's why they call it an illustration, a picture of what this policy could do over the years, correct?
No.
Basically a snapshot of what is an illustration.
And you said, and the only reason I disagree with you, Diana, is because you said could. An illustration is what it will do. This is not like going and taking out, well, like your 401k, right? You go to the 401k and they say, well, this mutual fund has averaged 10% over the years, and therefore, if it continues to do the average of 10%, this is what you're going to make. An insurance policy, again, is guaranteed. And so when I show somebody an illustration, it's an actual document that says, if you put in the amount that we've got here, this is what you'll have. So that's why I use it for banking purposes, because if I tell you this is what you're going to have in your bank account at age 45, 55, 65, 85, that's what you'll have. It's a guaranteed. So that's what's different. So I wouldn't use the word should, because that would, in my mind, indicate there might be some risk there.
Not should or could. It is a will. You do.
Yes.
You put in the payments, the insurance payments that you agreed to do, and there is some flexibility on those. But if you do what you said you wanted to do, you the plan, then you will have this result. Okay. Then the last thing I think answers the remainder of Sean's questions. I have the policy in place. How do I use it? How do I take advantage of having that money available to me?
Thank you, Diane, for bringing that back up that I had forgotten. So, Sean, let me answer that for you. And thank you, Diane, for reminding me of the end of his answer. So what you do is you go into the back office and I haven't, again, I gave this in the other presentation, but we become co-owners of these insurance companies. The ones that I use are not stock-based companies. They're mutual-based companies. So we own a portion of the life insurance company that we're actually working with, and the executives at those life insurance companies are working for and on behalf of us as co-owners. And so at the end of the day, it is my money. They make money. I make money. Now I forgot what I was going to say, Diane. Where was I heading?
Well, we're talking about how do you get access to that
how do you
money
get
once
access
it's
to
in
it?
the policy?
Yeah. So you go into your back office and you log in and you choose your policy and you go and you say, I want to take out a loan. And in that software, it'll say, okay, which bank account do you want us to send the money to? And how much do you want sent? And you hit yes. And depending on the company you're with, it's going to be anywhere between 2 or 3 days to 2 or 3 weeks if they send you a check. That's why you usually want it to go directly to a bank account, because it happens quicker instead of having them send you a check.
Yep.
But just figure within 2 to 3 days or 2 to 3 weeks, depending on what you ask them to do, you'll have that money back in your pocket. So it's not as quick as a debit card, if you will.
Okay. What kind of rate of return can you expect?
Currently, the companies that I'm working with and have been paying out a return of anywhere between 4.5, let's say 4.2 or 3, including the dividend, to say 6.5 each year. And when you want to borrow, the spread is usually 90 basis points that I've seen. Well, mine's even less than that, and I've seen them go up. I've never seen it go above 1%. Obviously, it could, because again, that's why I mentioned that we're working, we're co-owners with the company. So at the end of the year, they say, okay, this is how much we've made. This is the dividend that we're paying out. But the IRS, once again, does not consider it a taxable event, because it's just, they call it a return of your premium, because we're co-owners in the company. And so it's a non-taxable event. But when you take the guaranteed portion of your policy and the dividend portion and add it together, most companies are paying between, let's say, low 4s and mid 6s. And when you borrow, it would be mid 4s to high 6s, usually with a spread of less than, say, 90 basis points. Okay. Yeah, if you go to my actual website, privateequitybanking.com, I have a lot of different videos out there already. But I'll send you those other parts if you'd like. And then you can watch those. And hopefully all this will fit together. It just couldn't be done in one 45-minute sitting because there's just so much information.
Yeah. Yeah, no, I understand that. And it's a lot of this learning is just going to be repetition too.
Yeah. Hey, well, if you like this, folks, please tell somebody else about it.
Yep.
If you see it on my thing, share it with a friend. Go into the loan officer support area and give it a like so that others will come. If you think this can help somebody, share it with them. I'll get you the video. Thank you, everybody. Have a great evening.
Thank you.
Yep.
You too.
Yep. Bye-bye.